Hi, everyone, and welcome to another fresh new episode of our Made for YouTube series. I'm Sumaira Abidi, and today the topic that we're going to discuss is, in fact, something which is quite on trend, and that is debt ETFs. ETFs as an exchange traded funds. And joining in today to talk about all the trends and to explain the working of a debt ETF, joining me is Devang Shah, who's the co-head of fixed income at Access AMC. Devang, hi, thanks very much for joining in again and to explain a concept which is quite new still, even though it's been a while that we've had debt ETFs in the Indian market. But a lot of investors are still, not clued in, perhaps. So let's
Right.
start with the very basics, right? What are debt ETFs? How do they work?
See, debt ETFs are probably, I think, exchange traded funds which invest in debt securities, which somewhere down the line, see, if actually what a retail investor has options. Retail investor has option today to invest in mutual funds. Retail investor has option to invest in fixed deposits and at times on NCDs or bonds which are listed on exchange and buy government bonds. Now, I think debt ETFs provide you a platform whereby if an investor wants to have a diversified investment at a retail level, okay, which are small ticket sizes, and have a diversified investment into various securities, the easiest option for him is to buy a debt ETF, whereby there is an underlying benchmark which gives you all the details about what the securities are, what is the weight internally, what is the rating mix, as well as what is the duration and the yield for the specified ETF. So you get a lot of color about how individual securities are there, what is the weight about it, the issuer, the weights, accrual, YTMs, and all the maturity buckets. So this is how an investor, rather than just investing in one specific security, here I think he gets a basket of securities and they are easily tradable on exchange. So it is like buying an equity stock through a broker on exchange. A debt ETF is exactly similar to buying a unit of a debt ETF on exchange through a broker, and you get this underlying details about each and every security and other details, including duration and YTMs. So that is
Okay.
all about ETFs.
Devang, where we have equity ETFs, I think we as investors have understood the concept of, the benchmark quite clearly because we have indices that trade all the time, right? On the debt side, there's a little bit of confusion about how exactly this benchmark is created. What is it? Is it different for every kind of debt ETF that is there, or is there some sort of a standard benchmark that is used?
Right. So I think no, as you rightly highlighted, there can be different benchmarks for different kind of ETFs which are launching. So that I'm sure you have seen certain benchmarks or certain ETFs which are launched, which has one, I think CPAC, which is Central PSU and Public Enterprises, where the 100% of the portfolio will be investing into public sector enterprises or public sector units, which is all AAA rated. There can be a benchmark which is investing in overnight instruments, and it is a liquid benchmark. There can be other alternatives where you're taking AAA oriented state development bonds or government bonds with 100% into gilts. So I think the benchmark is something which can keep on change. It is for a particular debt ETF. The benchmarks are different, and the general constituents of these benchmarks, the underlying philosophy of how the benchmark is constituted, its weights, its duration, everything is specified when you actually offer a debt ETF. So all these underlying details of the benchmark are all highlighted and given to all the investors.
Okay. Who manages this benchmark?
So these benchmarks are managed independently, so they're by rating agencies and exchanges. Currently, I think NSC, BSC, rating agencies like CRISIL, all of these are managers of these benchmarks. I would say most of the ETF which are launched, NSC is the leading platform which manages this benchmark, but you can have it from rating agencies as well as exchanges. Both of these
Okay.
managers.
So just to understand it correctly, you will give an indication of the kind of fund that you want to launch, and therefore a benchmark will be created for it, right? A suitable one.
Right. So what they
That's how
do
it
is,
works.
yes, they identify. So example, if I believe that there are good opportunities for investors to invest in a 5-year gilt ETF currently. So what do? Is we discuss it with various those. So as I explained, to exchange and rating agencies provide us the service of creating the benchmark. We discuss with them that how the benchmark will look. They on independent basis will identify the most liquid securities, most traded securities, as well as the weights as per the regulations permitted on the ETF. They will try and construct a benchmark. And then how does a ETF work? A ETF then works very passively, has to replicate that entire benchmark and try to invest as per the constituents of the benchmark in those securities, and hence will start accruing and deliver similar returns to what the how the benchmark performs over the period or the life of the ETF.
Okay, Devang, I'm going to ask you to just indulge us a little bit more on this topic because, it's there are still a few doubts that I have. One is that as a fund manager, the fund manager will convey the macro view, right? Which is, like you said in this case, that over a 5-year period, gilts could be looking good, and the securities themselves are chosen by the creators of the benchmark, not by you as the fund manager.
Yes, they are. They are. There's a. I would say it will be jointly taken across by the rating agencies as well as the fund managers. But there is an independent criteria being set. There are minimum number of securities which needs to be held into a benchmark. Secondly, they also monitor factors like what is the liquidity in the underlying stocks, how frequently the benchmark needs to be monitored and changed, and what kind of addition and deletions can happen. So there is there's the entire criteria which gets set across while discussing and determining the benchmark. And once the benchmark is determined, then the fund manager role is just to replicate the benchmark and constitute the portfolio the way it is. So it is disclosed to the investors that these are the benchmark constituents, and at all point of times it will be a replication of those constituents of the benchmark to the best of the abilities to ensure that the tracking error is minimum, and from a fund manager and from the fund return perspective it replicates the benchmark returns.
Okay, so when you say that it will be replicated on a best effort basis, does it mean that necessarily not all the securities will be same? They could be similar.
So SEBI has given distinctive guidelines on this, at what percentage we can deviate from the from the benchmark which has been constituted. So there has to be similar securities. There are caps on duration. So example, if I've chosen a 5-year AAA corporate, which is a public financial institution, I can buy a plus minus half a year duration of a similar public financial institution. Those leeways have been given by the regulator. Secondly, on an overall cap perspective, also we cannot maneuver the duration significantly as compared to what is the benchmark constitution. So if the benchmark duration is X, we can have at max 5% plus minus duration, as well as an overall independent security. Also, the duration caps are there. They has to get replicated to similar securities, and I think at all point of time minimum 80% replication happens in similar and same securities. It is just the leeway is given to the tune of max 20%, and this is again for corporate and CPSC, which is public sector enterprise bonds and other instruments. For gilts, the replication is 100%.
Understood, understood. So basically, investors needn't get worried when they see that there is some variance because it will be an equitable kind of investment which has been made. Okay, the
Totally.
other thing about debt ETFs that interests me, one is of course that the cost is low, right? So which is the same case with an equity ETF. But while on the equity side, one can understand that because the market is very volatile and there can be sharp, movements, and you want to be able to take advantage of that movement. Therefore, you have this availability of an ETF, right, which itself trades and therefore is available for investors to buy and sell at their convenience. But the whole point of being a debt investor is that I'm looking at steady, consistent kind of growth, right? Why do I then need an ETF product? I mean, isn't it just an unnecessary temptation for me to look at trading while being a debt investor?
So I would say, see that what is the concept of an ETF is to give you a NAV. So if supposedly if you come across in a mutual fund scheme, how the mutual fund scheme works is you get a day end closing NAV. Okay, so that's how the debt funds function. Now, if an investor wants to capture, there are events on given days. You have monetary policies, you have announcements on budget, you have so many events. At times, you have some global events, some monetary policies across, which leads to wild swings or volatility in prices. If an investor wants to take a benefit of that, okay, I think the best option available through to him is through trade through ETFs. So that is why the ETF concept works across, is that to ensure and to try to take across that I would say benefit of intraday market volatilities. And in fixed income, we have seen time and again there are days where we get those volatilities. So it does add an element of additional, I would say, positivity to an investor, where if he believes so, he can capture that intraday volatility. It can get him some benefit.
Okay, but I will just sort of add my two bits in and say that retail investors, please be wary. Just because you have the option, you needn't avail of it. If you must look at, like Devang said, availing of that volatility, be very, very sure of what you're getting into. Okay, Devang, the next point is, currently, what is the universe of debt ETFs? What are the types, varieties, and what is the kind of innovation that is possible?
So, see, currently, if you look across at, we have probably the industry on debt ETFs would be in mutual funds would be close to 40 to 45,000 odd crores. If I look across at broadly the numbers, they would be in the CPSC, PSU, AAA gilt funds, which are the different types of ETFs which have been launched. All of them have, I would say, gained popularity in the last 12 to 18 months. We have some liquid ETFs. We can have constant maturity ETFs. So I think if you ask me, the basket of ETF is some where you can have a lot of innovations and lot of product ideas. Today, I think probably the most popular ones are the AAA oriented or gilt oriented or SDL, state development loans oriented ETFs, in broadly in maturity buckets of 3, 5, and 10 years. These are the most popular ones, but I don't see any reason that you cannot have an entire basket of ETFs in your portfolio, where depending on whatever is at that point of time the view, you can pick up that fund and or sorry pick up that ETF, and you can invest for a time investment horizon which is matching your investment horizon. So I think from an ETF perspective, we have a lot of innovations and optionalities possible. We can have constant maturities. Today, I think there is a lot of scare for the last 2 years or so on this entire credit fiasco, and hence we have seen all the ETFs having only AAA oriented rating. There can be ETFs which can also invest in lower rated papers. So I think the basket is significantly huge, and there can be lot many innovations and options available.
Fair enough. Uh, what is the difference in the profile of an debt ETF investor versus a debt fund investor? Is there such a thing that the two products are meant for different investors, or are they the same investor who invests for different reasons in different products?
I think they are the same investors. The only benefit which they get is, I would say, is they can, as you first rightly highlighted, is that they can take across and trade it during the day. It is more ease of trading through an exchange, which probably a lot of investors are used to, because they have been trading on through exchanges for equity stocks. So I think probably it is buying a debt mutual fund or scheme, okay, through an exchange, is what how do I construe it. From an investor class perspective, we don't see any kind of difference, because if you look across at the tax structure, if you look across at the investment horizon, your investment horizon is also quite clearly defined by the majority of the ETF. If, for example, it's a 2026 ETF, the investment horizon is 5 years. So I think two perspectives: one, easy tradability, and somewhere down the line you can deal in small quantums. You get that benefit of liquidity, and you understand what it is, diversified portfolio. So I think from a perspective on ETFs, there are not much differences between a mutual fund and versus an ETF, except for these basic contours.
Okay. I think somebody is desperately trying to get a hold of you, Devang. Is that your phone in the background that I hear?
No, so sorry for that.
No, no, not at all. In fact, we're sorry for, or rather, we're grateful that you've just kept away from work to help retail investors understand this topic better. The other thing, Devang, that I wanted to ask you is that there's some criticism in India that perhaps there is not enough liquidity on the ETF side. The other thing is that some of the issues had tracking errors. How big of a challenge is this really? I mean, is it practically a challenge, or is it more a theoretical problem that can be rectified over time?
See, I think liquidity is increasing day by day. So we have started seeing a lot of liquidity in ETFs. Previously, I think all these structures were very as you rightly highlighted, there was no much liquidity. But now with a lot of awareness among investors, the regulators also actually significantly helping to propagate ETFs. I think somewhere down the line, the thought process is that one, it's a good vehicle. It gives you a lot of clarity on what you are investing into. It gives you a diversified pool of securities. So from a perspective on liquidity, is on a day-to-day basis, it is improving. What I think from a challenges perspective, what an investor need to understand is one, that yes, they are trading through a broker. There are some cost involved in that, so all those costs needs to be taken into account. Secondly, yes, at times I think mutual funds also offer a platform where they define lot sizes in this, and if the lot sizes are higher, you can come and have those liquidities at the respective AMCs. So I don't see significant challenges, but I think people should be one, understand the entire constituents of the benchmark, as we discussed, that what is the actual maturity, what is the duration, what are the accrual YTMs of these products. Secondly, have an investment horizon which is very much similar to that majority of the ETF. And lastly, I think keep in mind about those costs and all. Liquidity, I think, should start improving. They've already shown a significant improvement, and we believe that the liquidity will continue to improve in these products.
Okay. And one final question, Devang, is that, since we're talking about debt instruments and the fear over the last 1.5 years has been that a lot of securities have defaulted. Now, I know that you mentioned that most of the ETFs are looking at AAA kind of, instruments. Nevertheless, we have seen AAA also, sort of go down the ladder very swiftly. While in a debt fund, there is this concept of a side pocket or a segregated portfolio, right? Where the bad apple is just taken out, put away, and the existing investors are not at a loss, right? As in when there is a recovery, they will get it. How does it function in a debt ETF? What is the provision made for a default?
So this all the debt provisions do apply to debt ETFs also. So they have a provision of segregated portfolios and all other aspects are there into consideration. But just to answer your question in simplified terms, if a AAA security is directly going to D on a given day, will there be a hit to the ETF? Yes, and there will be segregated provisions and everything which get triggered, and we'll have a segregated portfolio. But if there is a gradual downgrade of the security, then we need to rebalance the portfolio within the stipulated times as given by the regulator and ensure that the non-AAA component is replaced with a AAA component. So unless and until it's a scenario where a AAA directly goes to a D, okay, I don't see for a AAA or a AAA oriented CPSC or a PSU ETF to see any kind of credit losses, big credit losses. There will not be any credit losses for those funds. As I explained, one, there is rebalancing given by the regulator where we need to rebalance this position to a AAA exposure. And secondly, if in an event where a AAA goes to a D, then on those specific cases, the ETF unit holders will have those specified laws, and there will be segregated provisions as highlighted for mutual fund. They will get triggered for an ETF also.
Understood. And Devang, any last tips or tricks you want to tell our viewers about?
No, I would say, see, I think as highlighted by me, I think ETFs are portfolios which we all need to understand that these are simplified ways of investing into debt instruments. It's more for retail investors. They make a lot of sense. for retail investors to look into this. The only request would be this: yes, you need to understand what are the benchmark constituents, what is the maturity, what is the actual portfolio construction. I think post that, it is, as I explained you, it is like an passive investment that most of the fund managers will generally replicate the benchmark, and we don't see any challenges there.
All
So
right.
understanding the portfolio and the benchmark constituents is I would say a must before investing in a debt ETF.
Yeah, before investing in any kind of a scheme, I would say, and I would urge all investors and viewers who are watching this to really go back and see where your investments are, or if you're looking at making fresh investments, please do spend some time in doing the legwork. And if not, you must ask these questions of your advisors. Devang, thank you very, very much for your time today and for explaining the concept of debt ETFs.
Sure. Thanks. Take care. Bye.
Bye bye. So, with that, we've come to the end of this episode. If you have any questions and comments, do write them to us in the space below, and we look forward to reading all of them. If you have suggestions for topics that you'd like us to cover, do send those in as well. Thanks very much for watching. I hope this has been helpful. Stay safe.